Hi, welcome to Financial Accounting. This is our first video for a chapter. This will be about chapter 1. Now, having been both a student and instructor regarding online classes, I'm familiar with the challenges. We don't have formal lectures here. I had a couple of emails asking about how the class works. But I will be posting brief videos like these to kind of go over and help you through, give you examples for the most important things in the chapter, although you have to know the whole thing. Now, each chapter begins with learning objectives. The learning objectives are really important because what they say is they are what the publisher feels are the things that you should know when you finish the chapter. So let's take a look at the ones for chapter 1. Identify the ways accounting benefits society. Learning objective number 2, identify reporting identities. Number 3, identify the components of the accounting equation. Number 4, show how business events affect the accounting equation. Number 5, interpret information shown in an accounting equation. And finally, number 6, classify business events as asset source, asset use, or exchange transactions. So you'll notice just from the learning objectives a couple of things. Number 1, you're going to be learning 2 things this semester. Thing number 1 is the language of business, which is the language of accounting. Second is the concepts of accounting. One of those concepts, one of the basic concepts that you're going to learn is the accounting equation. You can see it's a big topic here in chapter 1. So the issue here that you need to address for yourselves individually is how best to learn the language, because unless you know the language, you're not going to understand the concepts or be able to apply them. I usually suggest it's kind of like going to a Japanese restaurant and the menu is written all in Japanese. If you don't speak Japanese, then how are you going to know what the menu says? You're not. So you're going to choose something from the menu, and then when fish head soup comes out, you're going to look at it and go, no. You need to understand language, and that's a lot of what we're going to talk about here in these chapters. And there's an interesting thing. If I ask most people if they can define accounting, a lot of times people think that accounting and bookkeeping are the same thing, and they're definitely not. All accountants are bookkeepers. All bookkeepers are not accountants. Excuse me. So the definition, that working definition we have here for accounting is information system that reports on the economic activities and financial condition of a business or other organization. So bookkeeping is the part of accounting where transactions are analyzed, recorded, and then financial statements, special reports are created based on that information that's been entered. Accountants will then take those financial statements, take that information, and analyze the company. That was my job. Just a little background for me. I spent 24 years as a financial controller in private industry. So it was my responsibility at the end of every month to analyze the financial statements, make sure everything was recorded correctly, and then report in a management meeting how the company did in the prior month and suggestions for the future, things that maybe need to be changed. So accounting is the bigger part. It's taking the information and analyzing it in a way that it makes sense to people. So here is that infamous accounting equation. All right, the accounting equation is very simply assets equals liabilities plus stockholders' equity. Pretty simple linear equation, right? For those of you who were excited about algebra. All right, so what are assets? Assets are things that the company owns. They could be, for a company, trucks, buildings, land, equipment. In your personal life, those of you who have cars, who used to drive to campus, you don't drive it now. But those of you who have cars, your car is your asset, or one of your assets. Liabilities, things the company owes. So those are going to be things like loans to a bank, if they borrowed money to build a factory or to buy a big piece of equipment, loans to buy trucks, things like that. Things that you owe, the company owes. For you, it might be the loan that you've got on that car that we counted as your asset. So you have an asset and a liability. Finally, stockholders' equity. And stockholders' equity is essentially the difference between what the company owns, the assets, and what the company owes, the liabilities. So assets minus liabilities. So if you liquidate your assets, you change them into cash, you pay off your liabilities, the things that you owe, what's left over is stockholders' equity. Now, another way to look at the accounting equation is through this assets claims idea. Assets equals claims. What that means is that there are essentially two sources, or not two sources, but there are two entities that hold claims against the assets. The first set are the creditors. The creditors are represented by the liabilities in the accounting equation. So the creditors have claims against the assets in the value of what they have put up that hasn't been paid for yet. It could be Staples with office supplies. It could be a computer specialist with services that were provided. The second group are the investors or the owners. They're represented in the stockholders' equity piece of the accounting equation. So the stockholders or the investors have claims against the assets. So those are the two claims. This number 3 here is a little different because actually operations, which represents the difference between revenue and expenses, otherwise known as profits, those profits are part of stockholders' equity, and we're going to see how that works in a second. So these are really the two claims against the assets. So, commitments made to investors are described in certificates called common stock. In order for a company, a public company, to get funds, to get money to do things, what they do is they sell common stock, hence the stock exchange that we're all familiar with. So stockholders' equity, the stockholders' stake or claim against the assets, is made up of common stock, what they've invested by buying stock, and something called retained earnings. Now, if you look up the word retained in the dictionary, you'll find things like held back, which is a pretty good definition. So retained earnings, these are earnings or profits that have been held back from the owners. They haven't been distributed yet. So those earnings plus the common stock investments are the stockholders' equity. And that's going to end us for this recording. We're going to go to video number 2 in a minute.